Welcome to the deep dive. Today, we're jumping into something really topical if you're keeping an eye on the Nepal stock market. It's certainly been eventful lately.
It really has, and our focus for this deep dive is exactly that, NEPSE, the Nepal Stock Market. We're looking at the recent volatility and, crucially, what the source material you sent over suggests for investors thinking about the second half of 2025.
Right. And that source is a pretty detailed article called Volatility in NEPSE, Expert Insights into Nepal Stock Market Current Gyrations, Key Sector Outlook, and Investment Strategies for Retail Investors in H2 2025. Quite a mouthful, but packed with info.
Absolutely. So our mission today is to, unpack that. We want to pull out the key insights for you, the listener, help you get a handle on what's happening with NEPSE right now, the economic forces at play, what's looking promising or risky in specific sectors.
And hopefully give you some practical strategies for navigating it all in the next few months.
Exactly. The idea is you come away feeling informed, able to make balanced decisions, and maybe a little less overwhelmed by all the market chatter.
Okay, sounds like a plan. Let's start at the beginning then. Volatility. It's the word everyone's using. What exactly is it according to the source? How do they define it?
The source uses a neat analogy, actually. Think of volatility like the weather for the stock market. It measures how much and how fast prices swing, up or down.
So calm days versus stormy days.
Pretty much. Low volatility is like a calm, predictable day. High volatility, that's your storm, sudden, sharp changes. It's really about the intensity of those price moves over time.
Okay, that makes sense. And how do they measure this? Market storminess.
The source mentions two main ways. Standard deviation that gives you a sense of how much prices have historically strayed from their average.
Yeah.
A bigger number means more unpredictable swings, more risk historically.
Right. And the other one was beta.
Yeah, beta. This one compares a specific stock's volatility to the overall market, like the NEPSE index itself.
How does that work? Like, what do the numbers mean?
So a beta of 1 means the stock tends to move pretty much in line with the market. If beta is greater than 1, the stock's more volatile. It tends to exaggerate the market's moves, both up and down.
Oh, I see. So if the market drops 1%, a high beta stock might drop, say, 2%.
Exactly. And if beta is less than 1, it's less volatile, more stable than the overall market, generally speaking.
So this volatility, is it just risk? Or is there an upside? What's the source's take?
It's definitely framed as a double-edged sword. High volatility absolutely means a higher risk of losing money quickly. That can be really tough, especially if you're new to investing.
Right.
But the source also points out for some traders, maybe those with shorter horizons like day traders, that very volatility can create opportunities for bigger profits if they can time the swings right, which is a big if, of course.
Right. And for the average long-term investor, the kind listening to this?
Well, for you, understanding volatility is less about timing swings and more about setting realistic expectations. Knowing the potential for ups and downs helps you build a portfolio you can stick with. The source suggests stable, lower volatility growth is often better for long-term goals.
So it's about managing expectations and maybe your own reactions.
Precisely. And recognizing when volatility picks up or cools down helps inform your strategy. Plus, the source makes a really important point about the psychology of it all.
Ah, the fear and greed aspect.
Kind of. It highlights how the perception of volatility is powerful. When everyone starts talking about how volatile the market is getting, it fuels anxiety. People worry about losses.
And then they panic sell.
Well, sometimes, yes. And that panic selling can actually cause prices to drop faster, which then increases the measured volatility. It becomes a feedback loop.
Wow. So the chatter itself can move the market.
It absolutely can. And the opposite is true, too. Very calm markets might lead to complacency. So the source stresses that market sentiment about volatility is a huge factor, not just the raw numbers.
Got it. Market mood swings are real. Okay, let's connect this to the bigger picture. What's the economic heartbeat of Nepal like right now, based on the article?
The overall economic pulse described seems pretty resilient, actually, especially compared to last year. The growth forecasts for fiscal year 25 are looking fairly solid.
What kind of numbers are we talking?
Well, the World Bank is projecting 4.5% GDP growth, the ADB is around 4.4%, and the government's own forecast is 4.61%. That's definitely an improvement on the estimated 3.9% for FY24.
Okay, decent growth expected. What's underpinning that?
The source points to a few key drivers. A recovery in domestic trade, solid output from hydropower and agriculture, especially rice. Plus, consumption is expected to hold up well, largely thanks to strong remittances coming in from Nepalese working abroad.
Remittances are always huge for Nepal, right?
Absolutely critical. And they're still growing. Investment, both private and public, is also expected to pick up, and the services sector is seen as a key engine for long-term growth.
What about inflation, and what's the central bank doing?
Inflation seems relatively contained. The average consumer inflation was about 4.72% around February 2025, which was actually a bit lower than the year before. ADB forecasts maybe 5.2% for the 2025 calendar year.
And the Nepal Roster Bank, the NRB?
As of their February review, they kept monetary policy stable. The main policy rate stayed at 5%, deposit rate at 3%, bank rate at 6.5%. Pretty steady. And the expectation is the Nepalese rupee stays pegged to the Indian rupee.
So, stable policy. You mentioned remittances. Any other strong pillars?
Yes, definitely. Remittances, as we said, grew significantly over 1 trillion rupees. That directly fuels household spending.
Yeah.
Also, foreign exchange reserves are very healthy.
How healthy?
Enough to cover over 14 months of imports. That's a really strong safety cushion against any external shocks. And trade figures were looking better too, with exports growing quite a bit in the first part of the fiscal year.
The source also mentioned the new budget for 2025-26. Anything in there particularly relevant for the stock market?
Yeah, a few things. The overall budget size is nearly 2 trillion rupees. Priorities are growth, infrastructure, social security. There are specific funds for things like startup loans and health insurance.
Okay, standard priorities. Anything unusual?
Yes, one really notable thing mentioned is a historic reform, allowing Nepalese businesses and individuals to start making partial investments overseas.
Whoa, investing outside Nepal, that sounds like a major shift.
It is. The source calls it a double-edged sword, which seems fair.
How so?
Well, on one hand, there's a risk that capital might flow out of Nepal, looking for returns elsewhere. That could potentially drain some liquidity from NEPS.
Makes sense. And the other side?
It signals growing economic maturity. It integrates Nepal more with global markets, exposes local investors to international practices, maybe even eases some pressure on the domestic market if good opportunities are found abroad.
So big potential impact, but maybe not immediately in the next 6 months.
Probably not immediately, yeah.
Yeah.
It's more of a significant long-term structural change to keep an eye on.
Okay, so summing up the economy. Growth expected, inflation managed, strong reserves, good remittances, some interesting budget moves. Sounds mostly positive. But the source talks about a disconnect. Why isn't the stock market consistently bullish then?
That's a really crucial point the source makes. Just because the big economic numbers look okay doesn't automatically mean the stock market surges. NEPSE's behavior is also driven heavily by factors within the capital market itself.
Like what?
Things like regulatory changes causing uncertainty, we'll get to those. Concerns about the health of banks, maybe. And very importantly, investor sentiment, how people feel about the market based on recent experiences, trust levels.
So it's not a simple A to B relationship between the economy and the market.
Not at all. Market psychology, specific regulatory issues, liquidity, these things have a life of their own and really influence NEPSE's day-to-day movements. You can't just look at GDP and expect the market to follow perfectly.
That disconnect is important to remember. Okay, let's drill down into NEPSE itself. What actually happened in the first half of 2025 that made it so volatile?
Well, the first 6 months saw some pretty significant swings. The source gives examples specific dates in May and June where the index dropped noticeably. And turnover, the amount of money changing hands daily, was all over the place. Sometimes high, sometimes quite low.
And fluctuating turnover, that signals uncertainty or something else.
It signals variable liquidity, and the source notes that in markets with lower or fluctuating liquidity, it can sometimes be easier for manipulation to occur or for large trades to have an outsized impact on prices.
Right. So beyond those price drops and liquidity changes, what were the main drivers of this volatility in H1, according to the source?
A really big one highlighted is regulatory action, particularly from SEBON, the Securities Board of Nepal. They've introduced new guidelines that seem to have made the market more cautious.
Like what kind of guidelines?
One major example is a huge increase in the minimum capital required for brokerage firms. It went from 20 million rupees up to 200 million.
Wow, that's a tenfold increase. What's the effect of that?
It's expected to force consolidation in the brokerage industry. Fewer, bigger players. That's a pretty fundamental shift in the market structure.
Okay, consolidation. Anything else from SEBON?
Yeah, the source mentions a slowdown in IPO approvals. Apparently, only 5 out of 84 applications had been approved since late 2024. That limits new investment opportunities coming to market.
Fewer new stocks to buy.
Exactly. And there was a specific directive involving Butwal Power Company and Nayati Hydropower, signaling stricter enforcement against potential conflicts of interest. Plus, a ban on trading for anyone on UN sanctions list that's tied to anti-money laundering. AML efforts.
So SEBI's definitely getting stricter. How's the market taking all this regulation?
The source seems to view it as necessary pain for long-term gain. These steps are aimed at making the market stronger, more transparent, better protected for investors.
But short-term disruption.
Yeah, in the short term, it creates uncertainty. Market participants need time to adjust. Consolidation takes time. Fewer IPOs change the dynamics. It requires patience while the market digests these changes.
Makes sense. What about the central bank NRB and the banking sector? Did they play a role in H1 volatility?
There was one key move mentioned from the NRB's February policy review. They actually reduced the amount banks need to set aside for potential losses on their highest quality loans. The provision went from 1.10% down to 1%.
Lower provisions. That sounds like it would boost bank profits.
Potentially, yes, on paper, in the short run. And apparently, the bankers had asked for this. But the source subtly connects this move to warnings from the World Bank and others about potential risk in the banking sector's asset quality.
So maybe masking a problem rather than fixing it.
That's the nuanced interpretation the source hints at. It's seen as a calculated risk. It might provide temporary relief to bank balance sheets, but investors should still look very closely at the underlying health of those loan portfolios. It's not necessarily a sign that all concerns about asset quality are gone.
Right, need to look under the hood. We mentioned cautious investor sentiment earlier. Was that still a big factor in H1?
Definitely. The source keeps coming back to it. Sentiment remains cautious, tied directly to these regulatory shifts and ongoing worries about potential market manipulation, something emerging markets like NEPSE can be more prone to.
And that cautious mood, combined with the shaky liquidity,
makes the market jumpy, prone to reacting sharply to news or rumors. The source also briefly notes that global market conditions didn't help either, adding to the cautious atmosphere.
Okay, that gives a clear picture of the H1 turbulence. Now, looking ahead, second half of 2025, where does the source suggest investors might find opportunities, or where should they be cautious? It breaks things down by sector, right?
Exactly. Sector analysis is key here. Let's walk through the main ones. Banking and financials first.
Always a big slice of NEPSE. How are they looking?
Well, their sub-indices were down in H1. The source sees potential positives if the economy picks up, boosting loan demand. And that lower provision requirement offers a temporary profit lift. But the big but is asset quality. That World Bank warning hangs over the sector. Slow lending growth and policy uncertainty are also mentioned as risks.
So the forecast for banking in H2 is?
Cautious, highly selective,
Yeah.
Focus on banks with genuinely strong fundamentals and balance sheets, not just those benefiting from the provision change.
Okay. Hydropower next. That always feels like Nepal's big long-term play.
It really is presented that way. Huge potential, like 72,000 megawatts possible, only around 3,400 currently installed. The game changer mentioned is the agreement to export 10,000 MW to India long-term.
That's massive.
It is. Plus strong government backing, big budget allocations, and the private sector is already heavily invested. Power purchase agreements, PPAs, are signed for thousands more megawatts.
Sounds incredibly promising. What are the catches?
The usual challenges for big hydro.
Yeah.
Very high upfront costs, long time to get returns. Political or economic uncertainty can delay things. Implementation can be slow. PPA pricing isn't always straightforward, and output varies seasonally.
So still challenges despite the potential H2 outlook.
Overall positive, according to the source, especially for companies that have clear export paths or projects well underway. Long-term, the outlook remains extremely strong.
How about insurance?
Insurance is showing really good growth in premiums, especially life insurance. In fact, the life insurance subindex was a leader in H1 growth. The big story here is low penetration.
Meaning not many people have insurance yet.
Exactly. Standard measures put it under 17%, so there's a huge untapped market. Growing awareness, microinsurance pushes, government health insurance reforms, these are all positive drivers.
Challenges.
Expanding beyond the cities, reaching lower income groups, getting people to stick with policies. But the forecast for H2 is positive overall, driven by that potential for growth from a low base. Companies with good distribution and new products should do well.
Manufacturing and processing.
It's a decent chunk of GDP, and it's attracting more foreign investment interest. The possibilities come from government support policies to protect investment, benefits in special economic zones, export help, better power supply helps too.
And the downsides.
Limited local capital infrastructure gaps. Nepal being landlocked is always a factor. Competition from imports. Getting policies implemented effectively is also key. So the forecast is moderately positive. Success depends on tackling those structural issues.
Okay. Tourism and hospitality, that sector's bounced back strongly in many places.
And in Nepal, too, according to the source.
Yeah.
Very strong recovery. Tourist arrivals were hitting records early in 2025. Nepal could actually beat its pre-pandemic peak this year.
Well, it's driving that.
Better health protocols, easier digital visas, promotion, plus Nepal's natural appeal. And the main airport upgrade being finished removes a bottleneck.
Interesting, though, the source said the stock sub-index for tourism actually declined in H1.
Yes, and that's highlighted as a potential disconnect. The real economy in tourism is booming, but the stock prices haven't necessarily reflected that yet.
So maybe an opportunity for investors if the stocks catch up.
That seems to be the implication. The forecast for the sector is very positive, given the recovery momentum. Challenges remain, like growing key markets sustainably and ongoing infrastructure work, but the outlook is bright.
Any other sectors briefly mentioned?
Yeah, trade was noted as volatile. Microfinance saw its index decline and is dealing with new interest rate rules. Development banks also saw their index fall in H1, facing similar issues to commercial banks.
This sector view is really helpful, but you flagged that disconnect again, booming tourism, lagging stocks. How does the source suggest investors think about that for H2?
It really emphasizes that point. Real-world sector success doesn't guarantee immediate stock market gains. Sentiment, liquidity, regulatory news, all these other factors play a huge role in day-to-day stock prices.
So the opportunity is finding strong sectors that might be temporarily undervalued by the market.
That seems to be the idea. If you believe in the fundamental strength of a sector like tourism or hydro, but the market is broadly cautious and holding those stocks down, that could present a chance to invest, assuming you've done your company-specific homework.
And the source also mentioned how these sectors link together.
Yes, the interdependencies. Good hydro means power from manufacturing. Banks finance projects. Tourism brings in foreign currency that helps banks and stimulates demand. Remittances, fuel consumption. It's all connected. Growth in one area helps others.
Okay, great foundation. So let's get practical. What concrete strategies does the source recommend for retail investors trying to handle NEPSE in the second half of 2025?
The core advice starts with perspective. First, think long-term. Try not to get spooked by the daily or weekly noise in a volatile market. Focus on Nepal's overall growth potential and companies that are fundamentally solid and well-run.
Easier said than done sometimes, but crucial. What else?
Diversification. Don't bet the farm on one stock or even one sector. Spread your money around. Different companies, different industries. If one part of your portfolio hits a rough patch, hopefully others will hold up better. It smooths the ride.
And knowing yourself is important too.
Absolutely critical. Understand your personal risk tolerance. How much sleep will you lose if your investments drop? And maybe even more importantly, your financial capability or risk capacity. How much can you genuinely afford to lose without wrecking your financial plans? Consider your income, your savings, how long you plan to invest for.
So align your strategy with your own situation.
Exactly. Younger investors with decades ahead of them can generally take more risk than someone nearing retirement, for example. And finally, do your homework.
Can't rely on tips from friends.
Definitely not. The source stresses doing your own research. Understand the business, check the financials, look at the management team, assess the growth prospects. Especially in an emerging market where rumors can fly, fundamentals are your anchor.
Okay, so those are the core principles. What about specific investment styles for NEPSE now? Growth, value.
The source discusses both. Growth investing means looking for companies growing faster than average. Think maybe some hydro or tourism players, potentially. They often reinvest profits heavily and might trade at higher valuations.
And value investing.
That's about finding stocks that seem cheap relative to their underlying worth. Maybe out of favor temporarily, but fundamentally sound. In Nepal, this means looking for sustainable advantages, good returns, smart management, and strong balance sheets, while being careful to avoid value-trap stocks that are cheap for good reason because the company's weak.
So for H2 2025 on NEPSE, which approach does the source favor? Growth or value?
Actually, it recommends a blend. Growth at a reasonable price, or RBP.
GARP, why that mix?
The thinking is, pure growth might be too risky if valuations get stretched in a volatile market. Pure value might be tricky too, given the potential for value traps or lack of perfect information in an emerging market. GARP tries to get the best of both.
So look for growth potential.
But be disciplined about the price you pay. Don't chase growth at any cost. Find companies with good prospects that are trading at valuations that still make sense.
That sounds like a sensible middle ground for this market. Any specific actions investors can take based on this GARP idea?
Well, use the sector analysis we talked about to identify promising areas. Then, within those sectors, dig into specific companies. Look for strong management, clear strategies, good corporate governance that's extra important given the manipulation concerns.
What about how you actually invest the money?
The source suggests considering systematic investment plans, or SEs.
Investing a fixed amount regularly.
Exactly, like putting in a certain amount every month. This helps average out your purchase price over time, which could be beneficial in a volatile market. It's often called dollar cost averaging. Apparently, schemes like Prabhu Capitals are available.
Good tip for smoothing out entry points. What else?
Stay informed. Keep a close eye on what CBIN and NRB are doing, as their actions really move the needle. Follow reliable financial news. And, given the manipulation risk, stick to your fundamental analysis. Don't get swayed by hype.
Any other practical points?
Yeah, remember to review your portfolio periodically, maybe once or twice a year. Rebalance if things have drifted too far from your target allocation. And don't forget, cost, brokerage fees, and taxes on any gains will impact your actual returns.
You mentioned earlier the regulatory push on things like KYC and AML. How does the source connect that to investing strategies?
It makes an interesting link. These efforts to strengthen Know Your Customer and anti-money laundering rules, partly driven by things like Nepal's FETF status, aim to clean up the market.
Make it harder for shady dealings.
Basically, yes. And the source argues that a cleaner market, one less influenced by illicit flows or manipulation, tends to reward fundamental investing more. If prices are driven more by genuine company performance and prospects, then doing your research pays off better.
So compliance efforts can actually make strategies like GARP more effective over time.
That's the argument presented. These measures might feel like bureaucracy sometimes, but they help build a healthier market ecosystem where fundamentals matter more, which ultimately benefits serious long-term investors.
That's a positive way to look at regulation. Okay, let's wrap this up. What's the overall takeaway forecast for NEPSE in H2 2025 and beyond? And what should listeners be watching closely?
The short-term picture suggests continued volatility is likely. The market is still processing those regulatory changes and dealing with uncertainty. But looking medium to longer term, there's cautious optimism.
Based on?
Based on the underlying economic stability, the growth, the reserves, and the genuine potential in key sectors like hydro and tourism. A big factor, though, will be rebuilding investor confidence and trust. That's seen as crucial.
And what specific things should we monitor?
Key indicators listed include any further regulatory moves from SEBIN or NRB, the main macro data points, GDP, inflation, remittances, reserves, crucially the health of the banking sector, especially non-performing loans, progress on big projects like hydro plants, FDI inflows, and market liquidity or turnover.
Turnover being a sign of confidence.
Yeah, the source suggests a sustained rise in trading volumes would be a positive signal that confidence is returning.
This has been incredibly helpful. It really paints a picture of a market in transition facing short-term headwinds but with some solid long-term foundations. It definitely sounds like a time for careful, informed investing.
Absolutely. Patience, research, and a strategic approach are key. And that leads perfectly into the final provocative thought the source offers.
Ooh, what's that?
It circles back to that FATF gray list situation and the AML-CFT efforts. While that's fundamentally about compliance, the source suggests that successfully strengthening these controls could actually be a major positive catalyst for NEPSE in the medium term.
How would that work? Better compliance leads to a better market.
The idea is that if Nepal significantly improves its reputation regarding financial transparency and anti-money laundering, it could become much more attractive to serious foreign institutional investors, the big global funds.
Attracting more professional, international money.
Exactly. More FII participation could bring greater stability to NEPSE, deeper liquidity, more sophisticated analysis. Basically, a more mature and professional market environment.
And that would ultimately benefit local retail investors, too.
Potentially, yes. Through things like better price discovery prices reflecting fundamentals more accurately, and a market that's perhaps less prone to wild swings or manipulation. It's an interesting angle. A positive structural shift potentially emerging from addressing a regulatory challenge. Definitely something long-term investors should keep in the back of their minds.
That really is a fascinating thought, turning a compliance necessity into a market advantage. A great note to end on. Thank you so much for walking us through all that detail from the source material.
My pleasure. Hopefully it provides a useful framework for thinking about NEPSE.
I'm sure it will. A big thank you to our listeners for joining us on the deep dive. We hope this equips you with some valuable insights as you navigate the market.
Stay informed, think long-term, and invest wisely.